Welcome to The Explainer. Today, we're going to tackle a huge question. How do economists actually measure the economic health of an entire country? It might sound ridiculously complicated, but you'll see it all comes down to one simple, really powerful idea.
So here's what we're going to cover. First, we'll get the big picture with the economy's circular flow. Then we'll meet the key players. After that, we'll check out the 3 different but equal ways to measure that flow. And finally, we'll talk about what these massive numbers actually mean for you and me. All right, let's jump right in. How on earth can we put a single number on something as massive and complex as a national economy? I mean, you've got millions of people buying, selling, and creating things every single day.
It really does seem like an impossible job, doesn't it? But economists have come up with a very clever and, honestly, a pretty elegant way of thinking about it that makes everything a lot simpler.
You know, the real key is to stop thinking about a country's wealth like it's a giant pile of cash just sitting in a vault somewhere. It's not. A better way to see it is as a constant circulation, a dynamic river of money, goods, and services that are always moving between different parts of the economy. So how does this river actually work? Well, to get our heads around it, we're going to start with a really simple model. Let's just imagine an economy with only 2 main groups of players.
And here it is. This diagram basically shows us the engine of an economy. On one side, you have households, that's us. We provide our labor, our work, to firms. In return, those firms produce goods and services, and they send payments, our paychecks, back to us. It's just a continuous loop. Now, what's really cool here is that this loop is actually 2 parallel flows happening at the same time. That inner loop, that's the real flow. That's the actual stuff being exchanged, like our work for the products we buy. Then follow that outer loop. That's the money flow, the cash that pays for everything. Our spending becomes the company's revenue, which then becomes our income. It just goes round and round. Okay, so if we want to measure the size of this entire flow, one really logical place to start is to just measure everything that gets produced by all the firms in the economy.
This is what's called the value-added method. The basic idea is to add up the market value of all the final goods and services that are produced. But there's a really important trick to it to make sure we don't accidentally count the same thing twice.
So here's the crucial part. We only want to count the new value that's created at each step of production. So to do that, we take a company's total output, and then we subtract the cost of all the raw materials and parts it bought from other companies. What's left over is the value that that specific firm actually added to the economy.
Let's make this a little more real with an example. So for a company we'll just call Firm X, we start with its total output. That's 90 in sales plus 10 from changes in its stock, which gives us a total of 100 crores. From that, we subtract its costs, 40 for materials and 20 for depreciation. So what's left? Right there at the bottom, you can see a net value added of 40 crores. Now just imagine doing this for every single firm in the country and adding it all up.
Now, to get an accurate number, economists have to be super careful. As we said, they have to avoid double counting. They also have to make sure they don't include the sale of used goods, like a used car, because its value is already counted when it was first made. And here's an interesting one. They do have to include the value of stuff people make for themselves, like a farmer eating their own crops.
Okay, so let's check out another way to measure this flow. It makes sense, right? If the value of everything produced is, say, $1 trillion, then $1 trillion must have been spent to buy all of it. So instead of looking at what's made, let's track what's spent.
And this is the expenditure method. It works by just adding up all the money spent on final goods and services. Logically, the total amount that was bought has to equal the total amount that was sold. Simple as that.
All that spending gets broken down into 4 main buckets. First, you've got private consumption. That's everything you and I spend on things like groceries and gadgets. Then there's government spending on things like roads and schools. Then you have investment, which is what businesses spend on new equipment and buildings. And finally, we add in net exports, which is just the value of what we sell to other countries minus what we buy from them.
And just like the last method, you've got to be careful about what you count to get an accurate number. We only count spending on final, newly produced goods. So, spending on stocks and bonds, that doesn't count. That's just moving money around. Same thing for transfer payments like scholarships. Nothing was actually produced in exchange for that money. And this brings us to our third and final way of looking at this. And the logic here is actually really neat. If $1 trillion worth of stuff was produced and $1 trillion was spent on it, well, where did that $1 trillion go? It had to have been earned as income by everyone who had a hand in producing it. So, with the income method, you calculate the size of the economy by adding up all the incomes. We're talking all the wages, all the rent, all the interest, and all the profits that are paid out by firms to households.
The source material breaks this down into three main types of income. First up is compensation of employees. That's basically all the money people earn from their jobs. Second is operating surplus, which is the income that's earned from property and businesses. Think rents, interest, and profits. And third, you have mixed income, which covers what self-employed people make, like a doctor running their own practice.
And again, the key here is to only count income that comes from a productive activity. So that means things like gifts, lottery winnings, or the profit you make from selling stocks. All of that is excluded. Those are just transfers of wealth that already existed, not the creation of new income.
Okay, so whether we measure what's made, what's spent, or what's earned, we should get the same number. That number is gross domestic product, or GDP. But what do these gigantic numbers actually tell us about how the economy is doing and about our own lives?
Well, one really important adjustment that economists make is for something called depreciation. Just think about it. When we're producing stuff, machines get older, buildings wear down. So to get a more accurate picture of our net production, we subtract the value of all the equipment and buildings that were used up in the process. This gives us a net number, like net domestic product, instead of a gross one.
And this chart here shows another absolutely crucial difference. When you hear that GDP went up, how do you know if we're actually making more stuff or if prices just went up because of inflation? Well, to solve that, economists use what they call constant prices, which you see on the right. By basically freezing prices to a specific year in the past, they can isolate just the changes in the quantity of what we produce. This gives us what's called real GDP, and it's the best tool we have for measuring actual economic growth.
And there you have it. That's how, in 3 different ways, we can put a number on an entire economy. But it leaves us with one final, pretty big thought to chew on. We figured out how to measure the quantity of economic activity, but what does that number really tell us about the quality of a nation's well-being? Does a bigger number always mean a better life? We'll dig into that next time.